Give us your sense of what the markets did this week. As I say, the equity markets weren't quite sure about it, but boy, the bond market really reacted. What did the jobs numbers tell us?
Today's Jobs Friday, and leading up to it during the week, there were other indicators for the jobs market suggesting that the jobs market's still very healthy and a lot of job creation is still occurring, particularly at services. So the jobs report was a little softer than the bond market feared. But you have to realize the bond market was really fearful of a super strong jobs report that would make the Fed have to do more than one or two hikes from here. And the jobs report, when it came in, we saw a couple of things. One, the two-year yield fell below 5%, but the 10-year yield rose above 4%, and it stayed above 4% today. I think the action on the 10-year yield is the really interesting action this week.
Well, are we getting to a breakthrough on bonds here, basically? Are we breaking through to new levels in the 10-year and, for that matter, the two?
That's the interesting question. It's, are we walking into a new norm? Yeah. And is that new norm the old norm from 10, 20 years ago? I think what's happening, particularly on the 10-year yield, being over 4%, is that the bond market's starting to run out of patience for the Fed to win this inflation war. Inflation is coming down, but it's coming down too slowly because it's been 2 years now that inflation's been well above the Fed's target. And if it doesn't come down quicker, I think the bond market's going to lose its patience.
Well, and if you look at things like the 10-year break-even versus the PCE core numbers, there's a very substantial difference now that there hasn't been historically. And one of those, I guess, has to come down or come up.
That's right. So when you look at 10-year Treasury yields at about 4%, the break-even, or essentially the inflation expectation embedded in that 4% yield, is about a 2.25% break-even inflation expectation, as we call it. So essentially, the long-term bond market has been saying it believes the Fed, that the Fed is going to get inflation back to its 2% target. But eventually is not good enough. I think the bond market's at the stage where it's saying you need to move faster, because if we have to reassess the risk of another inflation outbreak and you take more than a year or two to solve the problem, it takes you 2, 3 or more years to get back to target, the bond market's going to have to reprice its inflation expectation and risk premium.
As a student of the markets, what is your best sense of how long the Fed has, if I can put it that way? We're going to get CPI data next week. We're going to have some other data coming in. Most of us expect that there's going to be a 25 basis point increase in July.
Right.
The question is, what happens in September? What happens after September? How long does the Fed have?
So now we're going into the back half of 2023. And the first 2 years were that period of time where the bond market is willing to give the Fed a couple of passes. But now, if inflation doesn't get down faster, I don't think the Fed will be forgiven by the bond market over the long term. I think what you'll have is that the 4% 10-year Treasury yield, and perhaps even higher than that, stays there even as the economy continues to slow, because the bond market wants compensation for this elevated inflation risk in this decade that we're in.
If, in fact, we're baking on higher levels for the 10-year, let's just stay on the 10-year here, what does that mean for the equity markets?
Right.
Because there's a discount factor here, and typically equity valuations go down, and particularly in some of the growth stocks, such as tech, which has been doing pretty well.
Well, this week is about interest rates, and we'll continue to watch interest rates over the rest of the year. Next week, we get some more reports on earnings season. I think earnings will be about $55 in the quarter, or $220 for this year. The S&P is trading at 20 times this year's earnings estimate, and the tech sector is trading at 30 times this year's earnings estimate. The higher interest rates go, the stronger the earnings growth and real earnings growth that needs to be generated by the S&P and the tech sector to justify these valuations. The valuations are very demanding, and they're not being helped by these interest rates.
Okay, so let's assume for the moment that earnings actually measure up and actually support those valuations. Where's it going to come from? Is that from price equity ratios? Is that from top line growth? Where are we going to find it?
Well, most of the top line growth that we're seeing is really just inflation, and basically the same things occurring at earnings. And I do expect $55 of earnings for the second quarter, which would be down a few percent from last year. But earnings at the S&P have been about $55 per share on a seasonally adjusted basis for the past 2 years. So earnings have been flat since late 2021. Where's the earnings growth going to come from? Well, that's why the whole market's just overly counting on tech to make up for what's likely anemic earnings growth everywhere else.
Tech, and particularly some big tech, has really been dragging the market average up without a doubt.
That's right.
Does tech come down, or does the rest of the market catch up?
Right. I believe that, Mark, the tech sector is due for a correction. I don't know if it's in the coming days, weeks, but I think over the course of the rest of the year, that the tech sector will correct by about 10%. And for those who are in the debate about will the rest of the market catch up to tech, will that bring the market to even new highs for the year? I doubt it. I think in order to be bullish on the market, you need to believe that tech goes even higher. I don't think it's likely that the rest of the market will drive the overall market higher if tech doesn't climb higher itself.
Is AI going to save us?
AI may save the decade in terms of productivity and decent economic growth, but I don't think AI is going to save the really weak earnings growth I see for the S&P for the rest of the year.
What about government investment? Because we have Bidenomics now, as President Biden calls it. There's a fair amount of investment coming in. Industrial policy, that's exactly right, as we had in Japan in the 80s. Is that likely to kick in to really help drive growth and productivity? And if so, how long does it take?
Well, that's the thing. It will take time. We'll find out to what returns on investment and what productivity we get out of that over time. But in the meantime, we do see investment in manufacturing capacity in the United States, but manufacturing output has been weak, and we are still in this manufacturing recession. It's all on the service side of the economy that's booming right this moment.